I am ready to rock and roll.
Welcome, everyone, to another exciting episode of Secrets to Real Estate Investing. Today, we have with us a gentleman who is going to give you some tips and ideas on how to keep more money in your pocket and less in the government's. This guy has a very interesting past, and he's from the other side of the country from me, and a former New York City police officer. So with that, welcome to the show, Craig Cody.
Thank you very much for having me. Psyched to be here today.
Well, thanks for coming on and sharing your valuable time with our listeners to help people learn how to, I don't know if take advantage of taxes is the right way to put it, but to pay the least taxes they can in a legal way. So
how about keep more of what they make?
Keep more of what they make, yes, in a legal way, of course.
Of course.
So tell us about your background and being a police officer and a CPA. That's kind of an interesting combo I've never heard of before.
Yeah, it's a little different. I was in the police department for almost 17 years. I retired as a lieutenant. I went on to work in a international CPA firm, got my CPA, worked there for a number of years, and then went out on my own and built a practice. Got crushed in 2007 with the real estate debacle. Rebuilt the practice based on tax planning and helping clients legally keep more of what they make. So being proactive versus reactive. And now we're doing this planning about 7 or 8 years.
Awesome. I love it. So it's interesting that you went from being a police officer to enforcing laws to now you are helping people obey the law and try and keep the most. That's interesting. I love it. So tell us more about your background and what brought you into accounting from police work.
I always liked numbers. The police department, at least in New York City, was a 20-year retirement. So you had a plan for the eventual, am I going to do something else? And I kind of wanted to go into financial planning, and I figured I'd set myself apart and get a CPA. And I started doing that, and I really liked it. And here I am today. So
nice.
No financial planning, just the CPA practice.
Nice. I love it. So tell us, what is proactive tax planning and how can it minimize your taxes?
So proactive is basically, most accountants do a very good job of putting the right numbers in the right boxes, but it ends there. So when you're proactive, you're looking for legal ways for your business owner clients to keep more of their money. So, maybe you want to do something one way, but if you do it slightly differently, you're able to get a tax deduction for that. And that's what proactive tax planning is. So one example of that is, let's just say you have kids and they need braces. And most people would just say, okay, you write that off on Schedule A, your tax return. You probably get no benefit of it, and you lose it. Whereas when you think of proactively, you think, okay, how can I structure my business to take advantage of and write off those braces? And I would say, okay, well, you set up a medical expense reimbursement plan, and you get to write off those braces that are probably about $8,000 a year now. So looking for things you're doing and finding legal ways that you could actually take advantage of the code and make those expenses deductible.
Yeah, that's definitely a nice example. And while you're on this subject, I've got the great benefit of giving my kids payroll. I have 4 kids. Only my youngest is going to qualify for this year because the number 3 turned 18 this year. So I've only got one under 18 I can do this with. But why don't you talk about that briefly for people who have kids?
That's one of the big pluses with the new tax act. So it went from being able to pay your kid $6,000 a year before they actually had to pay some federal tax. Now it's almost $12,000 a year before they have to pay any federal tax.
Woohoo!
Yes.
I love it. Okay,
yes.
So that last straggler I have left at home, I can write off twice as much.
And the others, if they're not working, you could still pay them. The big difference was if they were 18 or younger, depending on the type of entity you have set up, you did not have to pay Social Security tax, which ends when they turn 18. So if they're in college or they're not working somewhere full time, and you want to pay them to do things for you, and they perform those job functions and you document it, then you could also pay them. So 4 kids, $48,000. So went from 24 to 48, which is, figure that out.
Wow, that's a lot. That's nice. Yeah. Interesting. Cool. I can't wait to hear more examples throughout the show here. Well, what is one of the biggest mistakes that you see small business owners making regarding taxes?
Failing to plan.
Ah,
Basically they're going to buy a car or a truck and they do all this research. Comes time for taxes, they bury their heads and, okay, I got to go see my guy in October, or I got to go see him in, maybe March. And I've done no planning at all. So if they took some time, one thing they discover is how to pay my kids, right? Just take a
yeah.
little bit of time, talk, communicate with your CPA. Hopefully they'll communicate back with you.
Well, and the big challenge that I perceive most business owners have is they don't know there is proactive planning, and they don't know they don't know what they don't know. So
Right.
they don't know what questions to ask. They don't say, oh, so can I put my child on payroll? And what are the tax benefits and ramifications of that? Oh, if I'm buying a car, like they don't know what the topics are. So maybe we could just take a couple of minutes and talk about what types of things could be opportunities.
Right. And that's why we wrote our book, The 10 Biggest Tax Mistakes That Cost Business Owners Thousands, because we grabbed like 10 of them. All right.
Awesome.
Real simple. There's no rocket science here. I'm not putting man on the moon. Okay. It's just taking the time to plan. And so we'll start with failing to plan. Then we have the wrong entity type. People start a business, they call up their attorney, and he happens to like LLCs, or he happens to like S corps and stuff like that. And, okay, that's what we're going to do. So if only the attorney and the CPA had a conversation,
Yes.
they'd figure out, okay, what's the best entity? What's going to work on both ends? All right. Maybe it is an LLC, but maybe it's an LLC taxed as an S corp. Who knows? So just take a little bit of time there to plan. Okay.
Yeah. Well, and my personal advice would be to throw in there, the attorney has one set of objectives and the CPA has a different, and they aren't always exactly identical.
Right.
So that's why they need to talk to each other, or occasionally you come across a CPA who's also an attorney that can maybe even form the entity for you. So that's nice when they understand both the legal and the tax ramifications.
Correct. And the key there is communication. And that goes between the client and the CPA, as well as the CPA and the attorney. Just communicate. If you speak with your CPA on a regular basis, he'll know what's going on, and he should be giving you some guidance.
And why don't you define what's regular basis? It's probably different for different people, but what's like the minimum that someone should talk to their CPA?
At the minimum, it's quarterly.
Wow. Okay.
Yeah, at the minimum. We talk with all our clients on a monthly basis, if not more than that. Because, like you said, you don't know what you don't know. So if you don't talk to me, I don't know what's going on. And if you talk to me, I know what's going on, and maybe I could tell you how to do something a little bit differently, save you some money.
Definitely. Well, I think if you're having monthly conversations, that's more than some people have with some of their family. So that's impressive.
That's true. But it all works out. It's kind of like, people, what's that saying? You're tripping over dollars to save pennies. Spend the time, communicate, and you'll figure out ways where you can save some money. So another thing we see people, they're worried about being audited. What if the government audits me? Well, if you're doing it right and you document it, let them audit you. I mean, most audits are not in-person audits. All right. So they're going to send you a notice and they're going to ask for something and you're going to send it back. But if it's a worthy deduction and you're doing it right, you shouldn't be scared.
Yep. I agree with that wholeheartedly. It's just nice if you keep your records in a somewhat organized fashion so you don't have a big mess to put together, because I've heard of friends and different people that go to an audit and they just have all kinds of mess.
Right.
Although sometimes that works to their advantage when they bring in stacks and stacks of paper and the auditor's like, okay, I believe you got it. And then they walk out.
Yeah, I've never seen that. I've seen where people come in and they're well documented and then, okay, you're in good shape. But another big thing is from the 2017 Tax Cuts and Job Act is the qualified business income, which is, depending on the type of entity you have, you can have a 20% deduction on your tax return for the income generated from your business. So if you make $200,000 on your business, let's just say it's an LLC, and you're getting a K-1 for $200,000, you wind up with a $40,000 deduction on your tax return against that $200,000.
Nice. That's a huge benefit.
Yes.
So what entities would you be qualified? Anything that's flowing through to your personal tax return, which is the 1040 for people that don't speak accounting,
Yes.
the personal tax return?
Anything that flows through, such as a partnership, an S corporation, a single member LLC, those are all flow throughs, and a sole proprietorship. There's a couple of caveats in there. That's why you need to communicate to make sure you've done what you need to do. And this is just a gimme that the government is giving.
Stimulating our economy, put more money back in our pockets, huh?
That's right.
Well, and you know what us real estate investors are going to do with it? We're going to go buy more real estate. I was just on the phone an hour ago with my local credit union saying, hey, the value of my house has gone up. I want to increase my HELOC, which may or may not be a write-off. Hey, maybe we can talk about this.
Yes.
If I'm using a HELOC, say I'm hoping to go to get $400,000 to $500,000 on a HELOC, which I plan to use to flip houses with.
Correct.
Is that a write-off or is it not?
So there's something called tracing of interest. So it would not be deductible on your personal return, but then it would be deductible on the, let's just say, entity or entities that you're buying the properties in and flipping. So you just have to trace it and document it.
Right, since I'm utilizing that debt to
Right.
buy investment properties or to flip homes.
So,
and then hence comes the record keeping,
correct,
right?
correct. And remember, you're not taking it on Schedule A, your personal return. You're taking it on whatever entity you have set up to flip those properties.
Well, and one thing also to point out here is if you walk into an H&R Block or try and do it on TurboTax with your own tax return prep, or somebody who may not understand what you're doing, they would take your, what is the mortgage interest form that shows your HELOC?
1098.
1098. They're going to see that, and they would automatically just put that on a Schedule A, right? Someone that wouldn't really know, you'd have to tell them, hey, I didn't just borrow this on my primary residence. I actually utilize this in my business to buy real estate for investment.
Correct. And nothing against H&R Block, but shame on you if you have a business and you're going to H&R Block.
Yes, I think it's going to cost you way more than you think it's going to save you. Would you agree there, Craig?
Tripping over dollars to save pennies.
Yes, for sure. So what's another thing that...
this is a thing we go through with real estate investors all the time. The wrong retirement plan. Maybe there's something you could do as a real estate investor with your retirement plan. Sorry about that. Maybe you could do something with that money. Is it self-directed? Set it up the right way. Use that money. Roll it forward, baby.
Yeah.
Just do it the right way.
So if someone what are possible retirement plans? We don't have to go in too deep, but you just threw out the word self-directed. What does that mean?
So it's basically, instead of having your 401k, say with Fidelity, you find a self-directed provider that serves as the custodian and record keeper of that money, and you move that money into that fund through a trustee-to-trustee transfer so you don't generate any taxable event. And then you take that money and maybe you loan it to people that are buying real estate, or maybe you buy a piece of property. You just have to be careful that you don't, cross over the rules, all right? But if you're working with a good self-directed trustee, they'll make sure that you understand what you need to do.
Yeah, there's huge benefits available through doing that. I mean, I got the great opportunity to, we did it with our kids' college savings plan, turned 30 grand, flipped a house, one every year or two. And over the course of, the last 8 years, we've turned that 30 grand into 200 grand by just not flip. I know if you flip too much, that's a bad thing. You can't do it a bunch of times in a year, right?
You have to be careful and follow all the rules. And, there's, I'm trying to think of what the term is, some type of business income. You just have to be careful.
Yeah. So you can do the same thing in a self-directed IRA or Roth IRA. Right. And it's a great opportunity, but follow the rules. And that's a whole other show. So,
yes.
So what's another item?
How about we talked about, hiring your kids, what can they do? Can they go around and check on your properties? Can they cut the lawn? What can they do as long as it's reasonable compensation? Tax court has ruled you can hire your kids as young as 7. I typically like to wait till they're around 11. They could do a lot more. Okay. And how much can you really pay the 7-year-old? All right. But now you could pay them up to $12,000 a year, and they won't have any federal tax. That could be huge.
Nice. And then they, with that money, could pay for their own soccer, and I was going to say braces, but braces wouldn't work because you want to write that off in that other way. But tell your CPA, tell them,
Please,
hey, what can we write? What are the expenses that this kid is paying for? And if you pay them, and then they pay for their own stuff, tutoring, I mean, all kinds of stuff.
In my first book, Secrets of a Tax-Free Life, I actually wrote a chapter on how to deduct your kid's soccer cleats. So along the same lines that you're saying, you pay them, they take the money, and then they pay for their camp or whatever it is, or if they go to private school, you could do it that way. So there's a lot of different things you could do, or you could just roll it into a Roth, put it into a Roth,
Yep.
So there's a lot of things you could do.
Yeah, if you want to be nice. I'm not that nice, so I'm going to make them earn it. So what's another one of the opportunities that people might? Well,
we talked about medical benefits, medical expense reimbursement plan. So, the kids need braces, set that up, or maybe you're a little older, maybe you need a little cosmetic dentistry, which is going to set you back about 25 grand. So now all of a sudden you make that a nice big deduction. So just looking to what the code allows you to do. So that could be huge.
Yes, definitely. I've taken advantage of that somehow. My husband is an employee of another company, and he gets, medical insurance coverage, but there's a lot that medical insurance does not cover. And the last couple of years, I think we've racked up 10 grand a year with my little family of 6 between, all the co-pays and uncovered part and all those things. So that reimbursement plan has really come in handy.
Right. So most businesses have HSAs, health savings accounts and stuff like that, or flexible spending. This would be in addition if you're going to spend more than that. It all saves. And then we have the home office,
Yes.
And how about the home athletic facility? So
tell us about that. I haven't heard of that.
If you have a home office, you could then have a home athletic facility, which is for the use of, your employees. You may be an employee and their family members. So which could be the pool, could be the home gym. Yes. Wonderful. Wonderful.
That's interesting. Is there a certain type of entity you would need to have to be able to have that?
Nope. Just any type of entity that you have a home office. So maybe, you have an office someplace else, but you spend about 15 hours a week answering emails, doing billing out of a room in your house. Mm-hmm. Now you have a bona fide home office if you spend about 15 hours a week there. And now you want to have a home gym or a pool. Yes,
I'm doing
wonderful.
It. I'm done with the pool, but I'm up for some new gym equipment in the house.
These are things you're already doing, and now they're deductible.
That is what I love to hear.
And now that you have a home office, now your transportation from one office to another is deductible.
Yep.
Whereas it's no longer a commute. So just taking the time and taking advantage of what the code says you can do.
Love it. And so many of us real estate investors, we don't know what's possible. So that's, guys, why you need to talk to Craig or someone to learn what's possible, because you don't know what you don't know yet. Correct. So what's another one of your favorite opportunities?
I think that was about 10 of them.
Okay.
Those are the big ones. I mean, we could get into other things that probably would not, like cost segregation is not a big real estate investor, for a flip person. But if somebody that's a buy and hold, cost segregation can be huge, which is, when they break that property down into typical, let's just say you have a rental property. It gets depreciated over 27 and a half years. Mm-hmm. If you do a cost segregation study, now you carve out different pieces. Maybe the furniture and fixtures gets depreciated over 5 or 7 years. The landscaping and sidewalks, maybe 15 years. So you get the same amount of depreciation over 27 and a half years, but you get more of it up front.
Yeah, and it's all about accelerating deductions most of the time, right? You want to accelerate the deductions and push back the income.
$1 today is worth a lot more in 10 years.
That's true. Very well said. So what are any other final things that you might want to talk about to advise people on? Or do you have any examples or stories of people that you've helped save money? And you can keep the names anonymous, protect the innocent.
We have a lot of stories, the typical business owner that comes to us, and business owner includes real estate investors because, there's a lot of things you can do with real estate investors. We're looking to save them at least $20,000 a year. We had one client that we saved $450,000 in year one, that was a nice number. He was happy. And once again, not rocket science. There was no rocket science there.
Well, that's a boatload of money. He should have been more than happy.
Yeah,
should have been adding you into the will.
He was happy. He was happy.
Nice.
And we had a couple of real estate investors a couple of years ago that we saved them $80,000 each. And They were also very happy. So you just have to know what you're doing, look for the opportunities and do it correctly and document what you're doing.
Yeah, well said. Well, listeners, Craig we have a couple of opportunities for you to learn more. And Craig, I know, has an opportunity for you to get his book. So do you want to talk about how people can get that, Craig?
Sure. My book is the 10 Biggest Tax Mistakes That Cost Business Owners Thousands. And they could go to my website, which is, and we'll give you for the show notes, but it's craigcodyandcompany.com /secrets to real estate.
Okay.
Very fitting.
Perfect.
Very fitting.
Yes.
And they could fill out a form and we'll actually send them a paper book.
Nice. So you can highlight it, take notes, and write all your questions on it. So then when you call Craig, you'll be prepared.
Correct.
Very well. What a good opportunity. Well, thank you. That's great. And that's, guys, where he's going to go into much more detail on some of the highlights he's just hit. Correct. And then for our free show download that you guys know I try to do every week for you, to get that, you're going to go to hardhatholly.com /98 because we're show number 98. And there, Craig is going to give you his summary of the Tax Cuts and Jobs Act. What's in it for you? You want to tell people a little bit about that?
It just gives you the basic things that are going to affect you, for 2018 and beyond, and what you can look forward to, and the different benefits. Just a little primer. Read it. Knowledge is power.
Yes, for sure. So one thing that's still kind of lingering in my mind is what happened with meals and entertainment, because pretty much every business owner and real estate investor wants to take that and deduction, and they are taking it. So how has it changed with that?
Well, it's mainly entertainment that has kind of gone by the wayside, and we're still waiting for Treasury to come out with some revenue procedures on it, but it looks like if I take you out to dinner to discuss business, it's still going to be deductible at 50%.
Perfect. Okay.
If we go to a sporting event and we have, dinner as a afterthought or after the game, that's not deductible.
Oh, okay. So you got to have it like real separate then. Okay.
Correct. So we're still waiting for some revenue procedure to come out on this. So that's not 100% set in stone, but that's what we all believe.
Well, I love taking my investors and clients out to eat. So I'm happy to say, if you're listening to the show, my investors, hey, I'm still going to take you out because I can still write off half of it.
That's right.
Yeah. Well, thank you so much, Craig. This has been super enlightening and helpful. And it's just good to know that you guys have great opportunities if you just start to communicate with your CPA and ask questions, because your CPA probably knows what is normal for expenses in your business. Craig would ask you, do you have kids? Do you have a home athletic facility? Like, he'll know what questions to ask you, but you don't know what to bring up with him. So definitely get in touch with Craig or with your own tax person. You've got to make sure they know what they're doing. And it's ideal if they have some experience with real estate investing, so they kind of know what your typical expenses are. So Craig, as we get ready to close off here, what would be any final words of advice here?
Final words of advice are, be proactive, talk to your accountant, make sure he's just not putting the right numbers in the right boxes. Be proactive.
Yes, very good advice. And if you've already done your taxes, Craig would probably, I'm putting some words in your mouth, but you might be willing to take a look at last year's tax return for someone, let them know if there's any opportunity for improvement going forward and or an amended return, right?
As part of our analysis process, we review prior year tax returns, and that's where we determine what we could have saved them going forward.
Yeah, so start now. Don't delay, guys. The more money you make, the more impact it's going to have in your life. Well, and just as one quick reminder, guys, if you prefer to get my download by text and you want to get a weekly reminder of when our new episodes are live, you will text to the number 38470. That's 38470. You're going to text the word hard hat with no spaces in it. Hard hat, all one word. And I will send you this download as well as our prior ones. So with that, thank you so much, Craig. Listeners, thanks for listening. And get out there, make some money, and keep more of it in your pocket.
Thank you for having me. Have a great day.
Thank you. Hey there, thanks for watching the video. Make sure you like it and click subscribe to get notified of more videos. And you can go to hardhatholly.com for a free download on secrets to finding great deals.